We are absolutely delighted today to have one of the leading scholars in finance, Professor Sandra Kendo. Now, let me see how to introduce Sandra, because she's an extremely active researcher in finance. I'll introduce her in terms of the research bodies with which she's affiliated at the moment. She's an active researcher under Group C, which is Finance and Resource Mobilization, of the African Economic Research Consortium, the ERC, which is a Pan-African research institution headquartered in Nairobi. She's also, of course, an active researcher of the Center for Global Finance here at SOAS. She's also an active researcher of the LOIT Lab, which is at the Catholic University of Lille. Indeed, that's the university where she's based as an associate professor in monetary and banking economics at the same university in France. And her interest does not stop on research only, of course. She is an active academic and teaching and leading academic programs there. She's the academic advisor on two main training programs at the Catholic University of Lille. One is the bachelor's degree in banking, finance, and insurance, and a master's degree in banking and finance. So it would appear that in terms of research and in terms of teaching and leadership of academic programs, her main interest focuses purely on banking and finance. But of course, the research issues she investigates are very wide, including innovations in impact investing, also in sustainable finance, also on financial stability, and also on microfinance market concentration, which indeed is the focus of the presentation today, where Sandra is going to share with us her ongoing research on market concentration, financial stability, and the funding models used in microfinance, and applying some novel econometric techniques to be able to uncover some interesting findings for us. And of course, this is work in progress, and we will, as much as possible, try to provide feedback, comments, and constructive suggestions. But maybe an opportunity for us also to be able to discuss the developments in this area of microfinance, microfinance research. And feel free to please come in with your comments as Sandra presents, but also, of course, we shall have a lot of time at the end of her presentation where we can take comments, questions, a discussion, and we can have it as a conversation. Okay, so let me have the pleasure of welcoming Sandra Kendo. You have the floor.
Thank you, Prof. Murinde, and thank you for all those raising points that you have just introduced to present me, and also what I'm just doing nowadays. So I'm really, really honored to share my current research topic with all of you. And for the topic of today is market concentration, financial stability, and the funding model. As you have well underlined, Prof. Murinde, so I'm really, really aware about technical issues. It is why in this paper, I've just targeted myself to maybe see how some econometric approaches could help to better improve how we are just trying to measure the different impact. Maybe I haven't put here the two econometric approaches that I'm just concerned about, but it is the GMM one that we usually used for the panel analysis. And since some previous years now, I've just discovered I can say an interesting technique, which is the Quantile regression, where by splitting the information by subgroups, we can better add light and see also other impacts, heterogeneous impact. It is why for this paper, I've just tried myself by just developing the different estimations, try myself to really compare the different results and maybe also make the things a little bit more clear about the differences that we can have in terms of impact. So to organize our thought today, I'm just trying to simply put some key points that we are all aware about this, which are the introduction, where I will just call directly the aim of the paper and also present a legal framework which is related to our topic, trying to also help us to get all in about the literature review and the concern for the part of the financial stability, what is the different issues there about the theory, and also about the methodology, which will be the third step. And I will try to just share the results with you. So, as I've said, the aim of the paper to help us to well keep this information and keep it as a focus for the presentation of today. So the aim of the paper is just trying to measure how sensitive the microfinance sector is when there is any changes. And the key factor that I've just take in consideration here are concentration, market concentration, and also the funding model. So when I'm talking about financial sensitivity here, it is how microfinance are exposed to risk. So the more the sector is just developing, of course, we can have some issues about the degree of exposure of the different financial institutions. And basically here, the one we are just considering are microfinance. So and the two key determinants that I've just trying to focus on and maybe trying to relate in terms of impact, as I've just announced, is the market concentration. And when we talk about market concentration here, you can easily picture yourself and have an overview about how for the big firms, they are just gathering or maybe trying to increase their market share according to some specific items. And here also the market concentration will be first of all, around asset, because it is the most used one when we try to analyze the market concentration to really measure how sizable an institution is just developing in a market. But we have just improved also our analysis by introducing two other aspects, which sounds a little bit more interesting for the microfinance sector, which are the deposits and the loans. So those two products are very important in the portfolio of the microfinance institution. It's why also we have just tried ourselves to measure the market concentration around those two additional products. And of course, for the funding model, it is another part that we have just considered as a factor that could modify also the risk exposure of the microfinance sector. Why? Previously, in another research work that is already published now, we have just looked how the funds the funds of microfinance institution could help them to better connect to other financial institutions as commercial bank. So there we're just looking about financial integration aspect and how financial integration was just taking place in the microfinance sector. So due to this, we have really observed an important role played by the funding model to try to help the microfinance institution to be connect to other financial institutions. And also in this case, the target was how they can easily diversify their capital structure. It is why in that other paper, because we were just aware about the diversification of their capital structure, we have also underlined the fact that the way they are just connect with commercial banks or maybe other type of investor to trying to diversify their capital structure, they are just opening themselves also to some additional risk. It is why here now in this second paper, which sounds for us as a logic, we have also tied the financial exposure risk of microfinance institution to also the type of funds that they are just gathering in their portfolio. So the two basic funds that we consider here in their portfolio are deposits and borrowings. For the borrowings, it is all the debt charges that they have by considering their action with other financial institutions. So two main questions that we have just tried to maybe analyze in our paper is concentration and financial stability, or concentration financial fragility. I will just give more information later, but I want us directly to keep the information in our mind. So the first aspect that we just try to just analyze here is the relationship between concentration stability or concentration fragility. And the second aspect is how the microfinance funds, the type that they have just trying to gather, could impact also such kind of relation previously mentioned, stability, concentration stability or concentration fragility. So let me a little bit trying to describe now the microfinance market, how the things are just growing nowadays. About the market, we have seen that, first of all, and I think all of us, for those who are a little bit aware about the microfinance sector, we are all agree about the importance of the microfinance sector and how microfinance institutions are just acting to trying to improve the life and also the well-being of the different population that are in need. So this is not a debate today. So about the success of the microfinance sector, of course, we have seen that we were just having a huge amount of investors and financial institutions that have raised their interest about this sector. It is why here I've just shared some figures about the different I can say incomes that we have in the microfinance sector, and you can easily see the amount there, which is a little bit more consequent, and also the growing process which is equal to 8.21%. And also another important information that I want to share with you is about how we can easily also organize the information to also see for the microfinance market. And of course, here we have, and if I can just precise this, about the different lenders that we have in the microfinance market. We have the traditional one, which are the microfinance institution clearly identified like that we can have. If I can split in details, we have cooperative and credit savings, we have NGOs, and beside this, we have also banks, non-banks that could also provide for microfinance services. And for the type of services, I've just put some type of services more than the usual one that we are aware about, which are the microfinance credit, the microfinance savings. So additionally, we have other type of services that are just growing also to try to fulfill additional needs, because previously we were just having those population with low income, but because of the success of microfinance, microfinance is now financing also small businesses, and we have a huge involvement of the microfinance institution to try to promote the entrepreneurship. So due to this, you can have some new services that are just taking more and more places in the microfinance environment that I've just put here as leasings, micro investment, and so on. So about the different area where we have microfinance, of course, we are all aware about the developing countries, but here this picture is just adding the information about other part where we can find also microfinance activities. And of course, I put there the key players. So this picture for me was just sounding as interesting and summarizing the adding part that we can have now to complete the traditional information that we have for microfinance sector. So let us have now an additional information also about the involvement of microfinance more than the low income. As I've told you, we have also all the involvement of microfinance that try also to promote entrepreneurship. So due to this picture is just giving us rapidly a good idea on the part or the percentage of income which is assigned to those part of entrepreneurship, which is more consequent than the individual one. So about the structure, to continue to describe the microfinance structure, this will help us to understand how the market is just designing. So about the structure, as I've told you, because of the success of the microfinance sector, we were just having an increase of different type of financial institution and also other type of investors that just involve more themselves to try to promote such kind of activity. So we can have, and we can see here some new of them, which is, I can easily underline this, the fintech firms that also more involved, and I think that everyone could relate about the role played by fintech after the COVID the COVID crisis, because we're just having all those digitalization process that have just trying to improve the different services during the COVID and after the COVID. So this is maybe a new part that helps us to also understand how the microfinance market has just rapidly changed in terms of shape after the COVID crisis. Another important aspect that I want also to underline here is about the dynamic that we have in the microfinance market. Sorry for coughing so much.
No worries.
So about the dynamic that we are just having in the market, we have sometimes, maybe in some reports, we have two, I can say, sometimes confusing information or clear information about the degree of competition that we can have in the microfinance sector, and also the fact that in the microfinance sector we have a high level of concentration. Maybe I want to clearly state and give some additional point here that could help us to well picture the competition issue that we have in the microfinance sector and also the concentration. So Basically, the microfinance sector, for sure, we have several institutions. But here, when we consider the size of those microfinance institutions or financial institutions that are just involved in the sector, we can easily split in two. We have something like 20 or 25% of large institutions that are just controlling the whole microfinance market, and we have that other 75%, which is just remaining as the small one. So in terms of percentage and in terms of market share and market control, we have large institutions that are just controlling more than 75% of the market also. It is why sometimes in the literature, for those who are a little bit more involved in such kind of aspect, you can easily understand why sometimes they are just talking about competition in the microfinance sector, which is real because we have a huge competition among the small microfinance institution or the medium one. But when we just consider the two categories, maybe the small one and the big one, there is no competition because for the large microfinance institution, they are just gathering the high market share. And when we look also at how the large institutions are just behaving according to the geographical implementation. Sometimes there are just one or two in some geographical implementation to handle also the different customers that are just in need. So due to this, we cannot easily talk about, and in a real sense, competition when we consider how the large institutions are just controlling more than 70% of the market. So in our studies, we have just underlined the fact that concentration is a better aspect to well describe how microfinance sector is just behaving, and not competition. Competition is for the small institutions, and for sure, the way the small institution will now act will be around the small market that they can easily attract, and how the small market are just expressing their self and expressing also their different needs. So we have another important aspect that we can just introduce here to try to improve our understanding about the microfinance market structure, which is the segmentation. So the segmentation approach helps us now to really divide the market into the small and medium size of microfinance institution and also the large microfinance institution, and how those microfinance institutions are just controlling the market, attracting the different customers and maybe serving also those customers. So basically, if we have something to keep in mind about the segmentation process, it is mostly controlled by large microfinance institutions that better provide the different products and services. So another important aspect, as I've told you at the beginning, is the funding model that the microfinance have just already developed till now. So the funding model is based on two main factors: how they collect deposit and how they are just able to just have or receive some borrowings. So because of this, the feedback, or maybe the idea in the back of the funding model, is trying to sustain and make the capital structure of the microfinance to be more viable. So the funding model that we are just consider here in our analysis will be, and the thought will be around those two basic factors: how they collect the different deposit and how they are just more how easy they can just get the different borrowings that they need. So, and what we saw in general that was sounding as interesting, but in terms of application, I haven't developed all of them, is that about the different funds that microfinance could get access, and that describe maybe their funding model. We have an extended one where in the financial integration paper, I've just clearly divided all those funds in terms of internal fund and external fund. So for the external, easily understandable, it is the different borrowings, and for the internal one, it is all the different resources that they can just have, or just trying to that they just have in their balance sheet, which are the different equities, deposit, and also domestic savings. So by considering the role play by the funding model, and we narrow our thought about the funding model here around deposit and borrowings also. So by just considering the role play by deposit and borrowing, for sure we have just underlined, according to the literature, some risks that the different financial institution in general could be exposed to. So we are just seeing that they can be exposed to bank default risk, where the credit could not be just reimbursed. And they can be in some financial troubles, credit risk, and systemic risk. So our concern here is the bank default risk, how they are just exposed themselves to the risk taken because they have just opened differently their capital structure. Some key issues now about the theoretical framework that help us to maybe sustain our thought and put in place those different hypotheses. So first of all, according to the literature, we have seen that the changes and the more attractiveness of the microfinance sector has been just encourage a new process, which is the commercialization. And about this, of course, we were just having some microfinance, and basically it is more small microfinance that were just more taking risks to trying to just compete with the large microfinance, as I've already explained previously. And about how the concentration of the large microfinance is just taking place in the microfinance sector, and how this concentration process is just maybe shaping the risk taken by the microfinance institution is not really developed in the literature. It is why here, to try to improve our understanding about the link between the concentration and stability, or concentration and fragility, we have just gathered some thought around the banking theory. So, according to some related research work for the bank environment, we saw that there are some important issues that was just raised as a debate because sometimes we were just talking about competition stability or competition fragility. So due to this, according to the banking literature, we have those two approaches that are just trying to maybe describe how competition, which is real in the banking sector, competition is tied to the stability, or competition is tied to the fragility aspect. So based on what we have learned from this banking literature, we have just tried to develop also our own thought related to the basic specificity of the microfinance sector. So for the microfinance sector, we cannot talk about competition. As I've told you previously, it is it is why for our hypothesis, based on what we have well acknowledged from the banking theory, we have just termed concentration stability or concentration fragility, which is more real and closer to how we have the fact in the microfinance sector. So this is the first basic hypothesis that we're trying to test for our research work. And for the funding model with the idea of the deposit and the borrowings, how the microfinance are just gathering those deposits and handling those deposits, and basically the large microfinance institution, the way they will handle the deposit and also the borrowings could impact also their degree of exposure to risk. It is why for the second aspect, we have just considered the liquidity analysis to try to also more consolidate our thought around the second hypothesis that we want to put in place. So basically, according to the literature, of course, we saw that the more a financial institution in general is just collecting and having liquidity, the more they are just taking risk. So there is a positive relationship between their liquidity level and also the fragility, means their exposure to risk. So they are not well regarding on the different actions or financial actions, because they think that, or maybe for the managers, they think that they can maybe take some additional risk due to the availability of the liquidity. So this is the basic idea for the liquidity part. It is why here, when we consider this basic idea that we have learned from the liquidity literature, we have just assumed that if a microfinance is just collecting more deposit, or maybe if a microfinance is just have an easy ability to have some borrowings, which type of relationship could we have? A more concentrate with fragility or concentrate with stability aspect. So this is also what we will test as a second hypothesis. So now about the methodology to test our two hypotheses that we have just put in place. Of course, the sample and our data that we have collected come from mixed market one, and we have crossed with the World Development Indicator data set. Because in our model, we have some macroeconomic information. That's why we have just cross and merged the two data sets. So about the different institutions, we have just having 3,114 microfinance institutions, and our concern about the different countries are the developing countries. It is why here also, for the thought in our paper, we have considered the different sub-regions that you can see there to well extend also our understanding about the behavior of the financial institute, of the microfinance institution in terms of risk exposure. And we have updated also our data set up to 2019. So to measure the degree of exposure of microfinance institution, we have just considered the Z-score. And maybe for here in our paper, the Z-score that we have just calculated is not for an institution, but it is not for a sector also, but it is for the whole country. It is why here for this huge and big formula, we have just introduced some weighted information in terms of sector and countries that help us to have an aggregate information at the level of a country. So the risk exposure that we are just measuring here for the microfinance institution are related to a microfinance sector tied to a country. Okay, so this is the idea, because sometimes also to make ourselves clear about the Z-score and the financial stability analysis, we can also develop the Z-score for each individual financial institution to measure also the risk exposure of one financial institution. This is not the case. Our case here is the risk exposure of the whole sector according to each country. So for the market concentration measure, we have chosen to use the FINAL index, which help us to better describe the market concentration. And maybe, as I've previously underlined, to calculate the market concentration, of course, we kept the first indicator usually used, which is the asset one, but we have just improved a little bit our analysis by introducing and considering the deposit and also the amount of gross loan portfolio. Some additional variable, because I didn't want to put all of them as I can say the Z-score and also the market concentration. So I've just clearly summarized all the different other independent variables that we have used in our model here in this descriptive statistic table, where you can see easily that we have deposit to asset, which is in the whole model, where we will estimate the relationship between stability and concentration. We have just introduced, basically at the first step, we have just introduced deposit to asset as the funding information, and of course borrowing to loans, to describe how we have just considered the whole information in our model. And for sure, to complete the analysis, we have just considered also the number of active borrowers, the macro information, which is the GDP growth, the inflation one, and so on. So maybe one thing that I can mention here that could help us to understand the different results that we will have. If we look about the Z-score, we have a mean information, which is 3.167. And the way we just analyze the Z-score, the higher the level is, the more the sector is stable. The low the information in terms of Z-score is, and the more fragile is the system. Okay, so if we have low value of Z-score, it is a fragility one, and if the information is high, if we have a high value, means that we have stability. So about the model, of course, we have a panel model analysis, and the panel model analysis that we have considered in our paper is a dynamic one based on the Arellano and Bond, that for some that use panel data are bodies. And the approach to estimate, the method that we have used to estimate this panel data is a GMM one-step estimator. Why? We have tested GMM one-step and GMM two-step, because those are the two approaches, and the one that gave a more stable and robust result was the GMM one-step estimator. When we're just using the two-step estimator, we couldn't have a robust information, and we're just having some losing information about the test of over-identification, which is necessary to validate our GMM model. So by introducing the robust aspect and also the test around the over-identification and the correlation or autocorrelation analysis. We were just having good information, means that we were just validating all those additional tests which are important for a GMM panel analysis. It is why we have just focused here for the approach to the GMM one-step estimator. And for sure, as I've told you, we will just compare also the result that we were just having previously from the GMM one-step estimator with the panel quantile regression form. So for this panel quantile regression, the method that we have just applied is the GMM also, because we have just trying to keep the same method of estimation and to well compare also the different results that we have just had at the end. And maybe what sounds really interesting about the panel quantile regression and the adding part here in our analysis is that for sure, we were just estimating the model, the relationship between the stability aspect and the market concentration, but we have the ability to just split the degree of exposure of the microfinance sector in different levels to a low exposure risk to a high one. It is why here really the really adding power to use this panel quantile regression is to see all the shape, the changing shape that we can have along the degree of risk exposure. So those equations that I've just put simply here are the way we are just terming equation for the panel quantile one, because we have to split in subgroup. It is why here for the estimation, we need first of all to have such kind of conditional information in terms of panel, and then we are just adding as a usual one the random part to try to explain the fixed effect and the random effect, which is related to equation 5, what I'm just trying to explain. So now in terms of results, here I have just choose to share this graph to help us to picture a little bit how those Z-score is just behaving according to the different sub-regions. So we have just played here. The information is a little bit tight from each other, but you can easily see the different shape of the Z-score for the different sector according to each sub-region. So for the first hypothesis now, I've just directly shared here the direct results related to the paper. So the additional variable, independent variable, I haven't developed because I want to first keep focus on the main hypothesis. So for the main hypothesis, the first one, the concentration fragility or concentration stability. So for sure, to try to test those two aspects, we have just estimate a linear model and a non-linear one to have directly the whole information and to see how such kind of link could be tied. So due to this, according to the first hypothesis, of course, as I've told you, we have considered the market concentration in terms of assets, deposits, and loans. So we can easily see, according to the different results, significant results here that we have a negative link between those two. And if you keep in mind the way I have just explained how we just analyze the level of the different Z-scores, of course, because of this negative relationship that we have, means that it is the concentration fragility which is closer here, which is real in our analysis. So So we have for this method of GMM one-step estimator. Now, if we have a look on the quantile regression estimator, the way we are just developing quantile analysis, of course, to compare the information split in different subgroups, we have to have basically a main line, which is the world model estimated. So in general, the world model that we estimate for the quantile regression to compare with the other is the ordinary least square one. So according to the ordinary least square one, we have also the same information as previously shared with the GMM aspect, means the negative relationship between the market concentration and also the fragility aspect. So we have the first column, which is giving us the information. And then what sounds interesting here is the different subgroups. And in terms of analysis for the different subgroups, for sure, by dividing by subgroup as we have here, the first subgroup means we are more exposed to risk because we have low value of Z-score here. And for the high subgroup, we have less exposure of a microfinance sector to a risk. So due to this, according also to the degree of exposure, which is clearly mentioned here on the different level of Z-score, we can also see the impact of market concentration on the financial stability or financial fragility. And what's appeared here is that the Greek impact that we have on the relationship already validated at this level means concentration and fragility one. So the high impact is where the microfinance sector is highly exposed to risk. So where we have a less exposure to risk, we have also a less impact that we can mention. And what sounds interesting here for this part is really to observe those degree of changes in terms of impact that we can have, which also underline the heterogeneous effect that we have from one subgroup to another subgroup. It is also why for the quantile analysis, one advantage that really we put in the front to try to make us understand how we can easily more go in detail in terms of impact, it is how we can have such kind of changes appearing here. And for sure, we have here, if we look about the deposit, for deposit, it is a little bit different when we just want to share the story around this, because by considering the two tails, the lowest one and the upper one, we have a huge impact, and in between now we have less consequent impact, which help us also now to be less affirmative in general by saying market concentration. For market concentration, we have for the microfinance sector where we have a high exposure to the risk, we have also a huge impact. So by also taking in consideration the type of market concentration according to asset, deposit and loans, we can see that the impact are also different. So we can just mitigate our result according to such kind of information. So by considering now the loan one, for sure, as we can easily see, and if we have well understood the basic explanations that I've shared, so we can see that for a high exposure to risk for a microfinance sector, the impact is huge between concentration and fragility linked, already validated. And the more for the loans, the more the stability is just taking place, the less the impact is also for this part of concentration and fragility. So we have also a nice story to share here about the market concentration loan aspects. So the second hypothesis that we have tested is the impact of the funding model. So for the funding model, we have just changed a little bit I can say the econometric approach. We have decided here to well value the impact of the funding model. We have decided to split the different funds that we have identified by 3 levels. So the lowest one, the medium one, and the highest one. So due to this, to split those different funds indicators, as you can see for the different statistics, descriptive statistics. So we have the low information here with the number of observation, the mean of the mean value of the low deposit, total deposit for the medium one and for the highest one. So see, this is the way we have just organized also the new subgroup. And in each subgroup now, we have just applied some estimations to test the link between concentration fragility or concentration stability. It is why directly here I can share also those results related to this. So for the lower, the medium one, and the higher one, we can also have some nice information here. So for the deposit side, for sure, we have some significant information between the lower and the higher. And for the deposit in general also, deposit, when we were just looking about our different results, we saw that deposit have better significant information than borrowing one. Means also, if we want to consider which type of funds are really impacting or modifying concentration and fragility or stability, we have to give more importance to deposit than borrowings according to our results. It is why here also to analyze the relationship between concentration, fragility, or stability, we have just considered, first of all, deposit as the nice one. And we can easily see for deposit that when we have a microfinance sector where the total deposit collect is low, we have a huge concentration fragility aspect, which is one information that we can just take out from this table. And also related to the assets. When we have just tried now to a little bit develop the same logic to the market concentration related to deposit and to loan, we were not just having some, I can say, some important results as the first one. Maybe we have just explained this by the fact that because we have already split our sample by deposit and borrowing, the fact that we are just again considering the market concentration deposit and the market concentration loan really reduce the quality also of the information that we can have for this second aspect, those two second aspects. So let me just raise some key points that we have just mentioned in our papers. So a significant inverse relationship in general that we have between Z, the Z is missing here, sorry for that, between the Z score and also our concentration indicator, which means that we have to validate in general in our paper the concentration fragility link. And also, as I've explained through the different figures that I've shared, we have some huge differences when we consider the different quantiles, which sounds interesting because we can just mention the fact that there are some significant heterogeneous effects that are just taking place when we consider a high degree of exposure to risk to a lower degree of exposure to risk. And as I've tried to just take out from the last table related to the funding model is the huge role played by deposit than the borrowing aspects. So here for the microfinance, where the total deposit collect is low, the risk sensitivity to market concentration of asset is high, which is one important result and conclusion that we can have in our table. So reversely, a microfinance sector where there is a high level of deposit, also the risk sensitivity is less related to the market concentration impact. And at the end, there's some heterogeneous impact between the highs and low subgroup that we have seen in between in our table. So these are the last word of our research, and I really hope that I've made myself a little bit clear about the topic of our paper.
So thank you. Yeah. Thank you very much, Sandra. Very, very interesting piece of work. First of all, you motivated the paper, very clearly. You also provided a very thorough background of the microfinance industry and its importance, especially in funding small and medium enterprises. And then you actually drove us into the literature, carefully identifying the debate. It was interesting to see the concentration stability nexus and also the concentration fragility nexus. And right at that time, I was predicting that there would be a U-curve. There would be either U-curve or an inverted U-curve because of the nature that maybe initially concentration might lead to stability and then eventually to fragility, or the other way around. Initially fragility and finally to stability. But of course, as it is always said, the nature of economic science is that a good theory can be destroyed by data. A beautiful theory can be assassinated by ugly facts. So you apply the data, and you had a very, very huge, you have a very huge database. I think very few studies I have seen which can be able to put together such a huge database in terms of the microfinance institutions, in terms also of countries, 123. You almost cover the entire globe, and for a long period of time. So we had a fantastic panel. What is interesting also is the funding model and addressing questions, the funding model, because you actually go back to the NCS in corporate finance. Okay, it matters how you fund the enterprise. And debt has got a risk element to it. Actually, as debt tends to 100%, then the organization will be bankrupt. So there is the traditional theory between leverage and risk is invoked here to see whether the funding model does matter. So very, very interesting piece of work, both in theory and also providing the first big tests in terms of the evidence. I know that a good number of people in the audience are researching these issues, especially my good friend is of Somalia at Laval University, has been doing some work with the colleagues at Cage and also colleagues at Groningen on a microfinance issues, microfinance models. So, interesting piece of work. And the data does stop in 2019, which means that we don't get opportunity to see the COVID impact, but maybe that's better because already the model is very complicated. It has various versions of looking at the loans, deposits, and assets. And then you have the funding models. So there's quite a lot of work to be done. Maybe introducing COVID would have been introducing shocks or those models, and maybe the message would have disappeared. But is microfinance still the same after COVID? I don't know, but this is a question that you can only do in your next paper, since you have a huge amount of data and you are not running out of steam. Then it means you can investigate some of these questions much better. Also thinking, running away with ideas, because one of the benefits of such a research seminar is that it gives, for you absorb what has been presented, you appreciate what was presented, make a critique of what was presented, but also it gives birth to many new ideas that are coming from this work. And of course, you have a global sample of 123 countries. Maybe there is a high degree, maybe heterogeneity in terms of the groupings of those countries matters. But then again, you could have so many groupings. And maybe then the results may disappear. But this is also a topic that requires a huge conference with the 20 participants, like the one you convened some time back in France with the Professor Chikoti Ebu on financing. So this is a good start for looking at issues. But let's go back now to the very paper you have presented in terms of the feedback. And please, if you want to provide feedback, put up your hand or just indicate in the chat, and so that we can be able to comment on this paper. Okay, I can see the first hand up by Professor Sulai Tumwine, who is from Makerere University Business School. Please go ahead.
Okay, thank you so much, Professor, for chairing the session, and thank you so much, Sandra, for your presentation on market concentration and financial stability. It's a good area that is worth researching about. I have liked it myself. And my key interesting points are on two things. They might not be questions, but they might be comments, depending on how you perceive them. One, when we look at your Handfield, HHI, you know that structure conduct performance gives us majorly 4 categories. One is the 0 to 50, which talks of shifting from perfect competition and then towards monopoly. Then the one of 50 to 70, which is oligopoly. 70 to 100, tending towards monopoly. And 100, which is strictly monopolistic. Now, my question based on that Handfield structural conduct performance is, I know those very many microfinance you studied are not at the same level. And you know, at that point, we are using the total assets of a microfinance divided by the industry assets for the entire microfinance in the industry to know in which category each bank falls. So why that author, Hanfido and Hitchman for the 1941 and 1950 categorized in that way was to enable that in case you are dealing with that, then it is better to know if they are 1,000 microfinance. Not all of them are at the same level, perhaps. The categorization I have just read would help you to know this is monopolistic or this industry is at this level. And then that will again take us to whether this bank is small, medium, large. So coupled with this Handfield, I would have maybe expected to see further than this to first carry out for us what we call an analysis of variance to see these institutions, are there significant differences? Because there could be a microfinance which has assets of $10 million another one of 5, another one of 3, another one of 4. Now, by categorization, they are either small, medium, big, or very big. Now, this will further be established by carrying out what you call a Turkey's post-hoc analysis to see are there significance differences. Now, my point is at that. If there are significance, now we are looking at, for example, if there's significance difference. If we talk about high exposure to risk, low exposure to risk, which microfinance is more exposed? Those who have a low market share or those that have a high market share, in line with your loans, the deposits, and all the assets. So when we get to know the basis of exposure based on how big or small or the significance difference you have established, now it would even help, because later I would ask you, what are the important recommendations you would recommend to who based on what? I feel like as this is the paper that is work in progress, if you would entice yourself to carrying out further the significance differences based on their sizes, in line with the loans and deposits and then assets, it would even give you a very strong, important recommendations if this is done. Of course, what you have is good, but this would be better if we know this, the SHI, where do these ones fall, then further carrying out a test of significance differences among different institutions. You can choose or maybe an ANOVA, but we prefer mostly using the Turkey's post-hoc analysis. This would give you, especially making important recommendations that can help these institutions and the country under which these institutions are located. I can stop there for now.
Thank you very much, Professor Tumine, for a very detailed and constructive suggestions on the paper. And it offers also great opportunities because if, for example, Sandra did undertake that extra work and obtained consistent results, that would be a robust way of concluding. If, of course, a researcher is an objective researcher, if the results are not, then it would provide a way of qualifying some of the results in terms of the, also, for example, the funding models, what works and what doesn't work. But Sandra, may I invite you to react, or do you want, or should I bring in, if Isof's comments along the same line, then I could bring in Isof and then you come last. Isof, is it along the same line or different question?
No, Victor. I mean,
Okay. Thanks. I know you're also working this. So let me give an opportunity to Sandra to respond to the feedback from Professor Tumine, and then I come back to you, Isof, next. Thank you.
Okay, thank you, Prof, for raising such kind of aspect. I haven't seen that, to be frank, because when we were just analyzing, when I was just analyzing the market concentration, I was just focusing on how the degree of market concentration, without taking in consideration those aspects that you have mentioned about maybe to go more in detail to see if we have a monopolistic one or oligopolistic. And maybe because also, according to the literature, what I was just having in the different report is what I've just trying to describe. How market is just dividing with this small part of large microfinance institution, and also another part with several small microfinance institutions. But what you have just raised here sounds for me as really interesting to try also to give more light to the different results, and maybe to be maybe more, I can say, to go more in detail to really identify the type of market structure that we have that could explain also this degree of exposure to the risk of microfinance institutions. So thank you very much for that, and I will try to really improve the paper in that way.
Thank you, Sandra. There are Actually, there is the African Competitive Report, 2009. There is this identification of the various models and trying to work within. It's a kind of granular way that Professor Tumino was referring to. Just the same way you granularly went into the quantile regression of showing how the behavior of different percentages also can be able to do some bands, but the bands within concentration. But I remember we did quite some work with Tia Shuza at Leicester. She's Professor of Finance at Leicester on that in the way back 2009. That's many years ago on the African Competitiveness Report, which is the World Bank report. Okay, so thank you indeed. And now let me have the pleasure of calling upon Isof. Professor Isof Somare from Laval University, a great friend of the Center for Global Finance.
Yeah, thank you very much, Victor. I mean, for this. Sandra, I mean, nice to see you again. I mean, always it's very nice to see you and to listen to you, actually. But I'm really, I will apologize for some probably what I would say. Probably you have already explained them because I was driving when I was coming. Then I didn't get a chance to listen to everything, actually. But I have two things I just want to mention here. The Z-score you are computing. Because when we compute the Z-score for the banking sector, we know most of the banks are profit-oriented, I mean, institutions. Then that makes sense, right? If you look at the variables and so on. But in your sample of microfinance, right, I mean, you have a lot of heterogeneities, actually. Some of them are profit-oriented, others are not profit-oriented, especially NGOs and so on. Then does the Z-score make sense for those type of financial institution? If not, then the measure of financial fragility you are computing, then probably you should really see how you can compute something which is more comprehensive, I mean, for all the microfinance institutions, actually. The other one is basically for the competition, right? Because you are looking at the competition, but something I didn't see here is almost like you are ignoring completely the banking sector. But at the same time, at the beginning of your presentation, you say you have another paper where actually you look at this interaction between microfinance and the banking sector and so on. Because I don't think, I mean, you can really analyze simply, I mean, like the concentration or non-concentration of the microfinance sector, the impact of that on the stability of that sector without really looking at really, I mean, the interrelationship between the microfinance sector and the other lending sector in general. Why I'm saying that, because you know that, I mean, some of those microfinance institutions, especially the profit-oriented one, the biggest one and so on, maybe the competition will be coming from the banking sector, right? I mean, we will be competing with the banking sector. And then if that's the case, how that also impact actually the stability or fragility of the microfinance institution somehow. That's, I mean, that's also the two main points I want to make.
Thank you, Yusuf, absolutely for comments and timely. Sandra, if you want to respond to the points.
Okay, so for calculating the Z-score, we have taken into consideration those profit aspect and non-profit aspect. In the formula, we have just weighted the impact. So it is why for the aggregate information at the level of a country, I have just taken consideration those two parts because the impact is not the same when I was just considering the asset level. So the way I weight the impact is with the asset level. Because asset for the Z-score, let me check again and share the formula. So here, so to calculate the Z-score for sure, so we have the weight introduced. This part, the W, is the weight that we have just introduced. And the weight impact here is just considered for the different type of microfinance that I've just considered for in the sample. So basically, as you have mentioned clearly, and you are right about this, the way the profit one are just behaving and the non-profit one behaving is not the same. And also, we have just considered in the denominator, we have also introduced another part according to the sub-region, because we don't have the same size when we consider maybe Asia one, where we have maybe several financial institutions with big impact, and also if I compare with, I can say North Africa, where sometimes we separate with sub-Saharan Africa. So we have also introduced in the calculation of the sample of the Z-score, also the weighted impact of the geographical environment. So we have those two information that we have considered in the calculation of the Z-score, and maybe there is another one because I have to check again other part of the formula to be clear. But for sure, we have just taken consideration such kind of information. And also maybe now for the second part, because when we calculate the concentration, when we have calculated the concentration one, we have considered the different types. But for me, I cannot see, maybe if you have more experience how to calculate the market concentration by introducing the information, the interaction with banks, maybe I'm just open to have the information. Why? Because for the mixed market database, when we look about the different types that we have all those, the NDOs, microfinance banks, and non-financial institution banks, and so on. So to calculate the market concentration, most of the time we use the mixed market one. But for me, at this level, I cannot easily see how I can just calculate the market concentration indicator by just taking in consideration the interaction with commercial bank. You are right for this, because it is giving another view about, I can say, about the dynamic of competition or concentration. So, as I have mentioned in another paper where we were just looking about financial integration, we have just tried to put in light this part of interaction of microfinance institution, all those types, with the banking sector. And the main indicator that we have used to maybe highlight those interaction was borrowings, because we have just assumed, according to the way we are just describing borrowings in the mixed market, borrowings, most of the microfinance institutions are just having their borrowings from commercial banks. So by using this indicator for the financial integration process in the microfinance sector, we have just starting an analysis about the interaction with the microfinance institution and the commercial banking sector. But for the competition analysis, I can really be frank, I have some boundaries about my knowledge. How can I measure competition by introducing, because the data is not allowing me to maybe develop such kind of things.
You are muted, Iso.
Yeah, I know, Sandra. I mean, for the second, yeah, I know. I mean, it's not easy, but I'm wondering. I mean, I don't have. I mean, the answer as well, right? I mean, but probably, I mean, because I know that in the World Bank or, I mean, development indicators data, you have the competition by country level, right, from the banking sector, actually. Then I'm wondering if you take those competition variables from the banking sector and then try to interact it with what is happening in the microfinance sector, that will say that basically, is there a very high competition coming from the banking sector or a low competition coming from the banking sector, and see really how that actually will impact somehow, I mean, your result. I don't know, I mean, just saying that, I'm just throwing that, I mean, from my head, yeah, but. But the last thing, I mean, Victor, if you allow me, is basically, I didn't follow, I mean, quite, I mean, the last part of your presentation, but what's the channels, right? I mean, through which basically all this happens, right? I mean, basically, and what is the channel through which, I mean, all this happens? I mean, this concentration or competition, or whatever the way you want to call it, from a microfinance and microfinance sector, and then bringing stability or fragility into the microfinance. I mean, the rest of the microfinance sector. What are the channels?
The channels too, I haven't well get your question.
Now the channels, I mean, through which basically the concentration will have an impact on the stability or the fragility of the whole sector.
Yeah. Yes, it's quite interesting, so I think, in the sense that the hypothesis is saying that market concentration may lead to stability, but it may well be the case that it can lead to fragility. Now, depending on what, and so that's the transmission mechanism. What is it that makes that difference?
Yeah, because you see, Victor.
Yeah.
Because you see, basically, because in the analysis shares of this, borrowing, right? I mean, some of them are borrowing. Then that borrowing can be coming from the market, right? Where you have the contagions coming from the market, which is bringing more instability into the microfinance sector, actually, right? I mean, it can be this can be one way, but there can be other ways, actually, I mean, to have this instability in the microfinance sector. That's why I'm asking, I mean, really, what's the channels, basically, I mean, to have this?
Yeah, absolutely. I think it's an interesting question, critical to this this paper. And maybe arguably, it could be that's where the funding model comes in. It depends on how the funding model works. If the funding model involves a high leverage ratio, that's more debt, total funding, then of course it will lead to fragility. The theory of corporate finance argues that as more debt, then of course the equity holders expect a more compensation for the debt being held, because then it becomes risky. Okay, but there is another way of arguing the same point but differently. We could argue this in terms of the price, that is the interest rate. And therefore, the price discovery process. The price discovery process is the way interest rates are formed, say, in microfinance or in the companies. But in microfinance, the fact that all these microfinance companies are not charging the same interest rates. They are variations. And why are these variations? These variations are in because they anticipate a level of risk. Okay, if they anticipate a higher risk, and they input a high risk premium, and it becomes and that's why more pricing, and of course that leads to maybe. But I think Isop has a very important point that it would be useful to articulate the channel, or hypothetically, of course, you could hypothesize on the channel, and then maybe reject it or accept it, or maybe the results. I don't know. How do you like to respond, Sandra?
Yes, you are right about this, because I was not just understanding very well the question mentioned by Isuf. So you are right, because the literature mentioned also some issues around the interest rate, and also some issues about the profit. So about the banking literature, basically, they were just raising the fact that if we have a competition, if we have competition fragility or competition stability, sometimes we just observe some variation in terms of interest rate. To be clear about this, so for competition fragility, the main aspect that they have just raised here is how the banking institutions are just taking more risk, and it is reducing their level of profit. So due to this, they are just having, because we have this, I can say, the reduction of their additional income means their margin profit. They are more exposed to the risk in the future. This is one way that they were just explaining how we can relate ourselves about competition fragility. And of course, for competition stability, they also mentioned some thought around the interest rate aspect. So due to this, it is based on such kind of understanding that for the microfinance literature, as I've mentioned, and according to the way they were just describing the sector, so I haven't considered the competition one as the big information that I have to just put in the front here, but concentration according to how the market, microfinance market is organized. So in the model, I've introduced maybe the leverage ratio also in the model. I haven't shared the complete estimation table because I was just thinking about to optimally share the information to help us to get through the paper. So I also introduced the leverage aspect, and what I have introduced additionally to try to see how we can have such kind of issue, it is the level of provision. If it is more declining, maybe we can also justify the fact that they will be more fragile in the medium or the long term. So, but I have maybe to well sustain what is just missing also at this level, because I haven't commented all the different results. So I have to sustain again I can say all those conclusions by clearly stating all those, as you have mentioned, Isuf, all those channels, clearly sustained with all those channels, because the literature have provided this. So it is up to me now, as I've told you, margin profit, or maybe the interest rate, the behavior of this that could justify why we have such fragility in the microfinance sector.
Thank you very much, Sandra. Let me see the show of hands. There are no hands up. I think, of course, Sandra is working on her paper, revising the paper. This will be available eventually, sharing with the participants in case participants want to give further comment. But I'd like to thank you, Sandra, for introducing this huge debate on the microfinance role. In a way, there are so many changes in this industry of microfinancing among researchers and practitioners as well, because, for example, a good number of development banks are using the banking sector as intermediaries, but the final implementing agencies are the microfinance institutions who are funding the small and medium enterprises. So in a way, the funding is coming from big multinational banks, local banks working as intermediaries, and then the microfinance workers. So the stability or fragility of the microfinance industry is so important in the financial ecosystem of every country. Now, for you, you've done the impossible of trying to spread it to 123 countries around the world, which gives, again, much more gravitas and the need why we need to pay attention to either stability or fragility in that area. So measuring the sensitivity is particularly important. And as you go, maybe you will be able to generate, I think, some notional quantitative values on how much stability is affected by 20%, or stability is affected by maybe 20%, which would give a notional view of a handle of a number that can be used to give a message in terms of the sensitivity of microfinance institutions to changes in competition. Yes, thank you once again for introducing us to this very interesting issue, kicking up a number of points that a number of people here could pursue or we could incorporate in our work. And we look forward to another enhanced view. It may come out in a journal very soon, in which case you can share a working paper for Center for Global Finance, in which case we're happy to issue it as a working paper for everybody to read. So let me ask all of us to put our hands together, and we give a hand of applause to Sandrine, Sandra, for this interesting work. Thank you, Sandra. Thank you indeed. Thank you.
Thank you again.
And,
Thank you, really. I really appreciate all the comments, and I haven't seen some of them, so I really appreciate, because I will integrate to improve my research work, my research paper. Thank you so much.